it's time now to begin your training on problem solving. Let's start with the very first commercial real estate loan scenario. So this is number one. This is for a purchase of a retail building to expand operations. The borrower's name is John Smith, and we're going to go over his profile. He is a business owner. He owns a small retail store, and his objective is to purchase a retail building to expand his operations. So let's go over the property details. The purchase price is $2 million. His annual gross rental income is $200,000, and the annual operating expenses are $40,000. In turn, the net operating income, or NOI, is $160,000, which you obtain by subtracting the $200,000 by the $40,000. You get $160,000. Now let's go over the loan terms. The loan to value, or LTV, is 75%, which means the borrower is coming in with 25% so that we reach 100%. Interest rate is going to be 6%, and it's going to be fixed for a term of 25 years. So the amortization term or period is 25 years. And this is very common for commercial loans, 25, okay? Now let's go over the loan request analysis. Number one, the loan amount calculation. So the loan amount equals the purchase price times the loan to value. So we're going to take $2 million, the purchase price, times 75%, and we're going to get $1.5 million, and that's what would be the loan amount. Number two, the monthly mortgage payment calculation using a loan amortization formula or calculator, which you can either use by going to Google and then entering mortgage calculator and then entering this criteria. The loan amount, $1.5 million. The interest rate, 6%. The term, 25 years. Now, the monthly mortgage payment, including principal and interest, is approximately $9,650 once you enter that information into the mortgage calculator. Number three, debt service coverage ratio, or DSCR. Let's go over the equation one more time. So DSCR equals net operating income, or NOI, divided by the annual debt service, or ADS. So the NOI in this case is $160,000, and the ADS is $9,650. If we do this on an annual basis, we would multiply it times 12, and we would get $115,800. So now we can do the math calculation. 160,000 divided by 115,800 equals 1.38. The lender requirement, at least for most lenders, the DSCR needs to be at least 1.25. So this deal meets the required minimum DSCR since it's 1.38. Now let's go over the problem for this scenario. The borrower only has $300,000 in liquid assets for the down payment and closing costs, but he needs to have a minimum down payment of, let's do the calculation, down payment equals purchase price times 1 minus the LTV. So in this case, we already know the LTV is 75%. So once we subtract 1 minus 0.75, we get 0.25, which is the same thing as 25%. So we're going to take the purchase price times 25%, and we get $500,000. So John is short $200,000, which makes this deal not possible unless he comes in with additional funds and he's able to secure those funds. Now, I want you to pause the course and try to find a solution. This is a problem-solving course, okay? You, as the underwriter, are finding solutions to everyday problems in the commercial arena. And if for any reason you're not sure, you can simply continue with the course lecture, but I still want you to try to think of a possible solution. Where can the borrower come in with additional funds and be able to proceed with this loan? Now, let's go over the solution. Step number one, seek a seller carryback, or a second mortgage. Now, the buyer can go back to the seller and renegotiate and ask them to carry back a 10% second mortgage, or for $200,000, because then that way we know that he's short $200,000, and that way he can cover those $200,000. In this case, he could negotiate with the seller a second mortgage with an interest rate of 8% and a term of 5 years, interest-only payments. So the monthly payment would now be $200,000 times 8% divided by 12, since there's 12 months in a year, to make it on a monthly basis, we get a payment of $1,333. So in this case, the seller would finance $200,000, and that way the borrower would be able to continue on with the loan. Step number 2, we need to adjust the DSCR with the additional debt. We need to go ahead and calculate the total annual debt service. So the first loan ADS is $115,800. The second loan ADS, or the annual debt service, is $1,333, which we just calculated on the top, times 12 equals $16,000. So the total ADS is $115,800 plus $16,000 equals $131,800. Now we need to adjust the DSCR with the net operating income and now that new total ADS. So we're going to take $160,000, which was the NOI, or net operating income, that we already knew, and we're going to divide it now by the total payments that the borrower needs to make on the first and second mortgage, which is $131,800, which now equals, once we divide both of those, we get 1.21. So we're slightly under the 1.25 minimum that the lender requires. Now, in terms of solution, as a side note, I just want to mention that sometimes some lenders may approve a deal with a DSCR just under 1.25 if the borrower provides strong financials or additional collateral. Step number 3, explore closing cost assistance or grants. If the DSCR is acceptable, the borrower can definitely proceed with the loan, as long as the lender allows that small difference. Alternatively, they could also seek closing cost assistance from local economic development programs or partner with an investor to share the equity and down payment. In terms of the final outcome, by leveraging a seller carryback and slightly reducing the DSCR, John is able to secure the property, expand his business, and meet his financial objectives. And over time, he can refinance the loans into a single loan after increasing the property value through either renovations or increased rental income, which is how you easily increase the value on commercial properties.